Yes, good morning, sir.
Good morning. Yes, we are welcome to today's class. So we have started for some time now. So where we started with some aspects, so where we started with the basis of assessment, and we have been able to look at the three scenarios. Under basis of assessment, we have looked at the commencement, the cessation and change of accounting date. So we have been able to look at that. So today we'll be moving to another topic, which is capital allowance. So capital allowance. So it's also a major topic and a major part of our syllabus, which we also need to familiarize ourselves with. So as a business entity, when you are engaged in business, either as an individual or as a company doing business, it is expected that that business you want to do, you want to carry out, so you are going to make use of some equipment, you are going to make use of some assets. So by the time you make use of those assets, the assets you use for the purpose of the business are also what liable for claim of what is called capital allowance. Under our financial accounting, so when you buy asset, non-current asset for the purpose of what? Business. So what we normally do is that we charge what? Depreciation annually on that non-current asset. And those depreciation will be what? Will be spread over the number of years that what we are going to make use of what? Of that asset for what? For the purpose of what? Getting back the money. The same thing is applicable for capital allowance. So what do we now mean by this capital allowance? So capital allowance, they are relief granted to what? Any taxpayer who incur what? Who incur qualifying capital expenditure for the purpose of trade or business during a basis period in respect of what? Non-current assets that are in usage at the end of the basis period. So purchase, when you spend expenditure on non-current assets as a business, when you spend expenditure on non-current assets, and those expenditure are for the purpose of what? Your business. So you are entitled to what? Or the claim of what? Capital allowance. So within what? Within certain period of time. So, and it is granted to what? All category of taxpayer. And according to the tax law, one of the pictures or principle of a good tax is that there must be what? Equity and uniformity. There must be equity and uniformity to what? To all taxpayers. That is what is applicable to taxpayer A must also be what? Applicable to what? To B. And if you look at our depreciation is usually granted based on what? Company policy. So depending on the policy of a company, we determine what is going to be what the depreciation. I can have company A and company B. Company A can decide that, okay, they buy the same, company A bought a motor vehicle. Company B also bought the same motor vehicle. At the same price, company A can decide that they want to depreciate their own for 5 years. Company B can say their own, they are going to depreciate it for what? For 10 years. So depreciation is what? Is based on what? Company policy. And if you are applying that to your tax liability, that is not what? Uniform. So what you have to do is what? You have to what? Apply what? A uniform rate. So as a result of that, capital allowance was introduced to allow for what? Uniformity in the what? In the application of what? Taxpayer activity. And this capital allowance you are going to be that is available to business is going to be what? Is going to replace the depreciation that is usually charged under our financial accounting. So in essence, what that means is that what? Depreciation is now going to be what? A disallowable expenses. So when you are preparing your tax liability, please, anytime you see depreciation under your computation of tax liability, depreciation is what? Is a disallowable expenses. So it's going to be what? Disallowed because Because what? Because you are going to what? Be granted what? Capital allowance. So in essence, capital allowance are those relief that are going to be granted to what? To replace your depreciation. So this has now given you a guide that anytime you are preparing an account and you are preparing an account for the purpose of tax, know that you are preparing an account, maybe adjusted profit or any other account for the purpose of tax liability. So whenever you see depreciation, that amount will be what? Will be disallowed. Because so you are going to be giving what? Capital allowance, which is what? At a uniform rate. So what are the features of this capital allowance? So features of capital allowance. So it is calculated using standardized rate. As I told us earlier, that's what there should be uniformity in the application to taxpayer. So you are going to use a standardized rate. So the same rate will be what? Applicable to what? To all category of asset. Where you buy a motor vehicle, company A and company B, the same rate will be what? Adopted to each of what? Each of the company. Then the method of application is uniform and consistent to all taxpayer, individual so the same way will be what? Adopted. The same way I'm applying for A is also what I'm going to apply to the transaction of what? Of B. Each amount will be claimed by a different taxpayer, provided that the assets provided that the assets were acquired on the same day and under the same circumstances. So where you acquire your asset on the same day and under the same circumstances, so the same asset will be what? The same value will be claimed. So the same amount will be claimed by what? By the taxpayer. Sorry. So the same amount will be claimable by what? By the taxpayer. Then we also have the next one, which is what? Another features is that the cost and date of use and other related matter are expected to be the same. So the cost and rate of use and other so are what? The same. The same set of rule apply to what? All taxpayer. So we are going to apply what? The same rule to all what? So the same rule will be adopted to what? To all taxpayers. So those are the conditions. So that's what features of what? Capital allowance. So what are now the conditions for granting this capital allowance? What will make what? A taxpayer to be what? To be liable to claim capital allowance. So they call it what? Condition for granting capital allowance. So please, I will advise also not to what? Focus our attention only on the what? On the theory, on the calculation part. The examiner can also ask you some of these or some of the condition or features. So which are also going to be what? Going to attract certain marks. So we should also what? Know some of these features and what? And the conditions. So what are now the conditions for granting what? Capital allowance. Conditions for granting capital allowance. Number one, expenditure must have been incurred on an asset. So what that means is that so you must, as a taxpayer, before you can claim cap, you must have spent money, spend the resources to what? To get what? To acquire that what? That asset. Resources must have been incurred, must have been utilized to what? To acquire the asset. Then we have the asset must be a qualifying capital expenditure. So those assets, for the purpose of capital allowance, we are going to be making use of that word, qualifying capital expenditure, which is usually shortened as QCE. You can call it for QCE. So they call it for qualifying capital expenditure, QCE. So they are what? So those are expenditure that we what? That qualify for what? Capital allowance. So they call those expenditure what? QC. So any expenditure that's going to attract capital allowance must be what? A qualifying capital expenditure. Because not all expenditure will be what? Qualified capital expenditure. We said if you buy a non-current asset for what? For the purpose of business. And non-current, they are assets that are going to last for what? For a longer period of time. If, for instance, there are some non-current assets that you also acquire, but are not those assets are not going to be regarded as what? Qualifying capital expenditure. For example, assuming a company acquire, let's say a taxpayer that is into business, acquire a stapler machine, sorry. Stapler, this machine that we usually use to staple our document. You know that particular machine, that stapler machine is going to last for more than a year. So when you buy that, you are not going to what? You are not going to, those assets may not be capitalized because what? The costs are what? Are not what? That's what? That much. So because they are not going to be capitalized, that particular asset will not be regarded as well qualifying capital expenditure because so that asset will not qualify for capital allowance. So asset that will qualify for capital allowance are what? Qualifying capital expenditure, QCE. Then the third one, the asset must be owned by the taxpayer making the claim. Any asset that you are going to claim, any QCE that you are going to claim capital allowance on must be what? Owned by the taxpayer. You must be the owner of that asset, except under what? A hire purchase agreement. Where hire purchase agreement is usually an arrangement between what? Between the buyer and the seller, whereby what? Possession of an asset is usually transferred to what? To the buyer until what? Until the final installment is paid. In which after the final installment, ownership will be transferred to what? To the buyer. So, but under the law gave the buyer an opportunity, a privilege to what? To claim capital allowance when the asset is acquired under what? A hire purchase agreement. So so for capital allowance, you must be the owner of that asset. Where the asset is what? Is borrowed or is just a temporary usage. Is on what? Rentage. You cannot claim a capital allowance. You have to be what? The owner of the asset. So before what capital allowance can be claimed on that asset. So the only time you can claim it where you are not yet the owner is when what? It is acquired under what? A hire purchase agreement. Because under a hire purchase agreement, you are still going to be what? The owner of that what? Of that asset at the what? At the end of what? At the end of the useful life. So you are still giving, so you still have what? The privilege to claim what? The higher purchase. So that is that. Then we also have asset must be in existence and in use at the end of the year of assessment under review. Any asset disposed before during the end of the basis period will not be entitled to what? Capital allowance claim in that year of assessment. Asset you want to claim capital allowance on must be what? Must be asset that you what? That is in this that we can what? See. It must be an asset that is visible, that you are going to what? That is available, not imaginary asset, not a QC that what you are imagining. Imagine that okay, I want to buy a particular QC in so year. You are yet to buy it. You are not. You now want to click. So it is not. It must be what in existence, and you must use it within that what within throughout that year that you want to claim the capital allowance. So what this condition now tells you is that anytime there is disposal of QCE, whenever there is disposal of QCE, that particular QCE that is disposed will not qualify for capital allowance in that year, except where you are otherwise instructed by the examiner. So in any year, so what I'm saying in essence is that in any year that a taxpayer dispose of its qualifying capital expenditure, that asset will not qualify for capital allowance because it is expected that you did not make use of that asset in that year. So you are not going to be entitled towards any capital allowance claim. So asset that you are going to claim capital allowance on must be what? Asset that is available throughout the entire useful life and what up to the end of what the basis period. Then the next one, the asset must be wholly, exclusively, reasonably, and necessarily used for the purpose of the trade or business. The asset must be what? Asset you are utilizing for what? For the purpose of what? Your business. It must be an asset that what you are using for your business activity. Where you are using the asset for personal usage, where it is used for personal usage, it will not qualify for capital allowance claim. So it must be for the purpose. It must be for the purpose of the business before what? Before capital allowance can be claimed on the asset. Also, an application must be made to the relevant tax authority. It is not granted automatically. You must write to what? To the relevant tax authority. Why? Because the tax authority, they don't know you. They don't know what you have within your company. You are the one that is going to give them that, okay, you have acquired what? This also asset with what? With applicable necessary what? Evidence for them to know that, yeah, these assets are available what? Within what? Within what? A company. So an application must be written to what? To the relevant tax authority. What usually happen in practice is that most especially, so when you are filing your return, you are going to what? Include those assets as part of your what? As part of assets you have already acquired. So with that, the tax authority, they have what? A knowledge of what? Of the asset. Then the tax authority will require what is called a certificate of acceptance for all qualifying capital expenditure in any year more than what, 500,000. So that is what we call certificate of acceptance, which is issued by what? By the Federal Ministry of Commerce, Trade and Industry through what? Through the Inspectorate Department. This certificate of acceptance is issued by what? By the Inspectorate Department of the Federal Ministry of Trade, Commerce and Industry. This certificate is to show that truly this taxpayer have what? This particular one, this particular qualifying capital expenditure in his what? In his premises. And it is expected if that expenditure, that particular class of expenditure is exceed or is up to 500,000 naira or more, where you are going to spend an amount of 500,000 naira to purchase motor vehicle or to purchase a particular asset, it is expected that you get that certificate from the Federal Ministry of what? Of Commerce, Trade and Industry through what? The Inspectorate Department. So those are the conditions that are required for what? Before capital allowance will be granted by what? By a taxpayer. So thank you. So those are the conditions. So any question? Any question? Any question?
Yes. My question is this. For capital allowance, when you buy Tokumbo machinery, can you still enjoy it?
Hello, can you repeat the question, please? I didn't get your question.
Yes. I said when a company purchase Tokumbo machinery, can they still enjoy capital allowance?
Yeah, yes, good question. There are conditions attached to what? To when an asset is acquired on what? On second-hand basis. So when you buy an asset on second-hand basis, you are also entitled to what? To capital allowance claim, depending on what? On certain condition, which we are also is also part of what we are going to discuss. So it's also part of our discussion as well. So we are also going to discuss about it. So it's part of the material. So, but I don't want to jump into it now. So we are going. So, but just know that when you purchase second-hand assets, you are also that asset is also available for what? Capital allowance claim, depending on what? On the category of the asset and what? And the condition, which we are still going to talk about. Thank you. Any other question? Hello. Okay. I believe there is no other question. So let us continue. So after that, so the next thing is what? Basis period for what? For capital allowance. Basis period for capital allowance. Basis period for capital allowance. So the knowledge of our basis period, the knowledge of the basis period we have under what? Our accessible profit. That knowledge is also expected and was needed during what? During what? Computation of capital allowance. Why do we need that what? That basis period? Because it is expected that your assets are not, as a business entity, you are not going to acquire your qualifying capital expenditure at once. Your QC will not be acquired at once. Your QC will be acquired based on what? Availability of fund. Depending on what, how you have what fund, we determine how your asset is going to be what acquired. So that means that tells you that what capital allowance also is not going to be claimed at once. So that tells you that the capital allowance is not going to be available at once. So it's also going to be available only when you acquire the asset. So in essence, how do we now what? Claim what? Capital allowance. So this will now what? Lead us to what? The basis way of for what? Capital allowance. Please, as we all know that we mentioned that the Finance Act has abolished what is called what? Overlapping and gap in basis period. It is possible that we may not have what? Overlapping and gap in basis period when we have what? During commencement of trade or scenario again. So as a result of that, because we may not have such scenario again, so your basis period for capital allowance is also the same basis period you have for what? For accessible profit. What that means is that the basis period you compute for your accessible profit is also the basis period you are going to adopt for your capital allowance computation. So what that means is that before you can solve any question on capital allowance, you first of all need to what? To come up with what? The basis period for what? For accessible profit. So that basis period you came up for accessible profit will help you, will assist you to know when what? When the asset will be available for what? For capital allowance claim. So in order to have a good understanding of what I mean by this basis period, so let me illustrate that. Yeah, so assuming, so let's say so we are given a scenario. So we are told that a company, let's say we are told information about a company. I hope you cannot see my Excel screen.
Yes, sir.
Okay, a company acquired a motor vehicle on 2005, 2020. So let's say we now have, and we are told that account date of the company is as at 31st December. 31st December annually. That's company accounting date. So that means if I'm doing my basis period for this 21 year of assessment, last year, 20 year of assessment, who can tell me what is going to be the basis period for this 2020 year of assessment? If the accounting date is 31st December annually, what is going to be the basis period for 2020 year of assessment?
1/1/2019 to 31st 12
Yeah,
2019.
preceding year basis. 1/1/2019 2019 to 31/12/2019. Why for 2021
Let me check
will
this
be hello any question 2021 will be 1/1/2020 to 31/12/2020. So what that means is that for this basis period you determine this basis period, this basis period is for the purpose of our what? Accessible profits. So this same basis period now is what we are going to use to allocate this asset for capital allowance computation. What this means is that you are going to look at the period, the tax year that is going to have this what? 30/05/2023. Which of the tax year can we find 30 May 2020? In which of the tax year can we find 30 May 2020?
2021.
2021. So what that means is that this motor vehicle will be available for capital allowance claim from where? From 2021 year of assessment. So we now have an asset allocation. So that's what they mean by what? Basis period for capital allowance. So this motor vehicle, you are going to start claiming capital allowance on this motor vehicle for what? From where? From 2021 year of assessment. If you are also told that they also purchase plant and machinery, let's say they purchase plant and machinery on 31/12, on 30/29/12/2019. Which year will this one come in? Plant and machinery. Which year? If it was purchased on 29/12/2019, which year will the asset?
2020.
2020. So we have it as plant and machinery. So this is what. So what this means is that for the basis period you what? You determine for your what? For your accessible profit will be utilized in what? In your asset allocation. Take note of that. Basis period determined for accessible profit will be available for what? For asset allocation. To know when the asset will be available for capital allowance claim. Take note of that. So that means what? So once you have already known, so it's in the case of this one now, this plant and machinery now, we are going to bring it in 2020 for capital allowance claim. Why this motor vehicle will be brought in 2021 forward for capital allowance claim. So the reason for this is what? For the allocation of the asset. So in what? In the respective year. So what that means that if you are given a question on what capital allowance, the first thing you first of all need is to what? First of all, do your basis period for what? Accessible profit. Without the basis period, you will not be able to what? To solve what? That question on what? On capital allowance. Let us take note of that. And it is also possible that what? If you are given a question that is having the three scenario, I told you can have a question that is going to have commencement, cessation, and what? Change of accounting date. If you are given the three scenario, you may have a situation, there may be a situation of gap and overlapping. When the three scenario are combined. So where you have a scenario whereby you have what? Both what? Commencement, you have cessation and what? Change of accounting date. You may have a scenario of a gap and overlapping in what? In the basis period. So when you now have that, how are we going to what? Solve such scenario. So what do we mean by this situation of overlapping? So let me first of all explain that overlapping. What they mean by overlapping is that what? The same basis period, one basis period will be common to what? To more than 1 year of assessment. So this can occur when you have what? These three scenarios combined together. So in this scenario of overlapping, you can have 2020, let's say we have tax year 2021, we have 22. We now have, by the time we have the basis period, we have 1 2019, 2019 to 31 12 2019. By the time this one now want to comment, this one now comment from 110 2019 to 1 12 2020. So this scenario, you can see that we have overlapping. What the overlapping between 2019 to 1/12 2019. So that is the period of the overlapping. See, this 110 2019, which is October, November, these 3 months, you can find it in year 2020, and you can also find it in what? Year 2021. This scenario is called what? Overlapping of basis period. So please, let us so if you now have a scenario like this, if they now tell you that what? Motor vehicle, if they now say motor vehicle was acquired on 1/7/2019. When do I know to bring this motor? Am I going to bring it in year 2020 or in year 2021? Because I have that date in the 2 years. If you look at it, that date is common to the 2 years. So what the law now says is that what? When you have what? Overlapping of basis period. So the overlapping period, overlapping period will be allocated to the basis to the earlier tax year. What this means now, what? The overlapping period will be allocated to the earlier tax year. What this means is that what? The basis period for capital funds now will now be 1/1/2019 to 31/12/2019. So which this one will now start from 1/1/2020 to 31/12/2020. So this, what I did here now is only for what? It's only for the purpose of what? Allocation of the assets. Please take note of that. This basis period I did here is only for allocation of assets. So when you are computing, you are going to use this one. This for the purpose of computation. This one is because of there is what common what they are common to it. So you must know what when to. So when you have now done this, so you will now see you can easily what allocate the asset to what to the respective. So if the motor vehicle was now bought on 1/1/2019, it will be available for capital allowance in what 2020 what year of assessment. Any question? So any question?
Yes. I want to ask a question on the first one, where
Okay.
an asset was purchased on the 29/12/2019, and the basis period is 1/1/2019 to 31/12/2019. So
2019,
buying that
yes.
asset like 2 to 3 days before the year end, does it mean that the person will claim the full capital allowance for that
Yes.
year?
Yes, it's going to claim the full. Capital allowance computation is available based on the number of basis period, for accessible profits, not based on what? On when it was acquired. Capital allowance computation is based on what? Number of months in the basis period. Take note of that. Capital allowance computation is based on what? Number of months in the basis period. Even though where the asset was acquired on the last day of the year, it will be available for capital allowance in full on what? How many months? It will be on the number of months you have what? In the basis period. Exactly. So that's that. Any other question? So that is for that. Then we also have a scenario. You may also have, so when there is what, when the three scenarios are combined together, you may also have a scenario of what is called a gap in basis period. So you may also come across that gap in basis period. So what do we mean by this period of gap? So what we mean by period of gap is, let's say we have 2020, we have 2021. So you have a period of 1/1/2019 to 31/12/2019. So when you now get to 2021 now start from 1/3/2020 to 31/12/2020. Because of what? This can occur because of a change of accounting dates. When there is a change of accounting dates, you may have a scenario like this. So in this case, you can see that we have what is called gap. So you can see there is a gap between what? 1/1/20 to 2020. So you have a gap between January and February of 2020. What that gap is means that you will see that you cannot see that basis period among these basis period. That basis period that you cannot find there is what is called what? Gap in between what? In between the basis period. So this period of gap now, we also need to what? So if you are now told that what an asset, they now bought motor vehicle was acquired on 31/2020. If I want to allocate this basis period now, if I want to check 31/2020, I cannot find it in between this basis period. What the rule is now stated is that what? The period of gap should be allocated to the later basis period. Basis should be allocated to the later year of assessment. What that means is that that period that there is a gap, that period will be assumed to be what? The second year of assessment. So the basic period for capital allowance will now be, this one will be 1/1/2019 to 31/12/2019. That period between 1/1/2020 to 28/2/2020 will now be given to what? 2021 year of assessment. So this one will now assume to start from 1/1/2020 to 31/12/2020. So in order to be able to allocate that asset for what? For the purpose of what? Capital allowance claim. And this, what you did there, is only for what? For the allocation of asset. Only for asset allocation. So let us take note of that. It's only for what? Asset allocation. So that is what? For what? For the purpose of what? Capital allowance claim. So that is what? When you have what?
Hello, sir. Yes, sir. Please
Yeah?
ask something.
Okay.
So, I think I'm a bit confused in this situation of gap.
Okay.
So I'm thinking gap occurs when in the situation whereby company is trying to change their accounting date. So, but this one now, the accounting date is still 31st of December.
This is just an illustration now. We are not looking at practical scenario. This is just an illustration.
Okay, sir.
You get it? So it's just an illustration.
Hello,
when you
sir.
have practical scenarios, so you have a situation. Yeah, hello? Okay.
You know,
I'm with you.
when we were doing basis of assessment, you said gap is when the accounting date is earlier than the commencement date. You know, like
Okay.
doing this now, I don't know, you know, we are like the second year of assessment, the 2021, you know, there's a change of date. Like you're even seeing something like maybe the company has a change in accounting date or something.
What you are saying here is different from what we did then is what? That one is what? Gap in what? In year of assessment. This is what? Gap in what? Basis period. There are two entire things. There's
Okay,
what? Gap in year of assessment, which I told you that That one, Finance Act has eliminated it at all. Where you don't, this gap in year of assessment, you can only have it when you have where the three scenario is being combined. If you look at the last question we solved last week, the question that is having both commencement, cessation, and change of accounting date. If you look at that solution, you will see that by the time you wanted to apply that change of accounting date, there is a particular year that there are certain period that were omitted. That period is what? Gap. That is what? Gap in basis period. That particular scenario, if you have a single question, like maybe you are given a question that relates to only commencement, you are given a question that relates to only change of accounting date, you are given a question that relates to only cessation, you cannot have what? Anything like gap. You cannot have anything like what? Overlapping in basis period. It's not possible because it has been eliminated by what? The Finance Act. Because the Finance Act has strictly stated that what? Basis period should strictly be on what? Preceding year basis. But this one will occur. So that where you can have gap in that scenario is what? You can only have gap in what? Year of assessment, not in basis period. So that is the one we discussed the other. This one is what? When you have gap in what? Basis period, due to what? A scenario when you have what? The three transactions combined together. So is it clear? I hope it's clear now.
Yes, sir.
So any other question? So that is what? The basis period for what? For computation of what? Of capital allowance. So that's how to work. So please. So that basis period, so when you are given a single scenario, so the basis period you determine for your assessable profit will also be what? Utilized to what? To allocate the asset to what? To respective year of assessment. So that is what the basis period. So what are now? So we are mentioning capital allowance. So what are now these various capital allowance that are claimable by what? By taxpayer. So there are different capital allowance that taxpayer can claim. So depending on what? On the nature of the asset. So we have various capital allowance that is claimable by a taxpayer. So the first category of capital allowance that is claimable by a taxpayer is called what? Initial allowance. Initial allowance. It is usually written as what? IA. Initial allowance. So initial allowance. So what are now the features? So what are now the conditions that must be present before you can grant this one? Initial allowance. So the first one is that it is granted once in the lifespan of an asset. As the name implies, initial. It is what? First. So it is granted once in the lifespan of what? Of an asset. So anytime so you buy a qualifying capital expenditure, you are going to claim what? That's what? Initial allowance once. It is available once in the what? In the lifespan of the asset. Then it is granted in full, irrespective of the number of months in the basis period. Somebody asked a question earlier that asset that was bought on 29/12. This is a good way to illustrate it now. That was bought on 29/12/2019. Does it mean that it's going to be available for full capital? Yes. So this initial allowance, you are going to claim it in full. So it will be claimable irrespective of whether you have what 6 months or 3 months in what. It is not prorated. So please take note, initial allowance is not what? Is not prorated. It's going to be granted in full. So it is granted in the first year, the asset is put into production. So once you have determined that, okay, this asset is going to come in for capital allowance in so number of years, in 2020 year of assessment, the first category of asset capital allowance you are going to claim will be what? That initial allowance. Is the first category of capital allowance claimable. Then it is taken into consideration to determine the tax written down value. So what we mean by the tax written down value is the value of an asset afterwards, after the capital allowance has been claimed. So this tax written down value is simply what? Is simply determined as a cost minus what? Initial allowance. So tax written down value is what? Cost minus initial allowance. So the tax written down value we are talking about. So tax written down, TWDV, is equal to cost The cost of that asset minus what? The initial allowance you calculate will give you what is called what? The tax written down value. So this initial allowance, you are going to use it to what? To get what? The tax written down. That is the value, the cost, the value of the asset after what? After capital allowance has been claimed. And this is calculated as what? As cost multiplied by what? Tax rate. So there are standard rates available for what? For each category of assets. So which we are still going to talk about. So the rate. So just look at what? The category of, if it is motor vehicle, just look at what is the rate of what? Initial allowance. So you multiply what? The cost by what? By the rate to get what? The initial allowance. Please, it is not what? It is not prorated. It is charged in full, irrespective of what? How many months you have what? In the basis period. Then any unabsorbed initial allowance in a year of assessment can be carried forward indefinitely until it is fully utilized. So if, for instance, you know, we said capital allowance, they are what? They are relief that is claimable for by a taxpayer, so which is going to be claimable from your assessable profit. Before they charge your assessable profit to tax, it is expected that you remove your capital allowance. If, for instance, your capital allowance, your assessable profit, let's say we have an assessable, so let me share this. Let's say we have an assessable profit. Let's say we have an assessable profit of, let's say, if we say an assessable profit of 200,000, assessable profit of 200,000, then you are supposed to less capital allowance. So let's say we now have a capital allowance of, let's say, 350,000. So what this means is that what this assessable profit that we have, we cannot remove this our entire initial allowance. Our entire initial allowance cannot be removed from this assessable profit. We can only remove what? 200,000. So capital allowance relief, we can only relieve 200,000 because that is the profit that we have for that year. So we can only remove what? 200,000. So what that means is that we are going to be left with what? 150,000. So this 150,000 now, the law gave you a right as a taxpayer to what? To take it to what? To subsequent year until what? Up to what? Up indefinitely. You have a right to what? To carry it forward to what? To the next year, and so on and so forth. In as much as what you have what? Profit to what? To relieve what? The capital, the initial allowance. So let us take note of that. So that's how to what? To calculate what? Our initial allowance. So initial allowance, so is what is where, so that is the first category of allowance that is claimable on an asset. So after initial allowance, the second category of asset we have is what? Annual allowance. So annual allowance. It is written as what? AA, annual allowance. As the name applies, once they say something is annual, that means what? It will become coming year in, year out. Annual, every year. So this annual allowance is claimable throughout the lifespan of an asset. So you are going to claim it throughout the lifespan of the asset. So it's not going to be available only once, unlike what? Our initial allowance. You are going to claim it throughout the lifespan. It is calculated on straight line basis, yeah? It is prorated based on the number of months in the basis period. Please, when you are calculating your annual allowance, I made mention that computation of capital allowance is based on the number of months in the basis period. Where the number of months is in the basis period, where the number of months in the basis period is, where the number of months in the basis period is less than 12 months, the annual allowance is also going to be based on what? On that number of months. Unless where the examiner asks you, so there may be ask you to what? To charge in full. There may be scenario whereby the examiner will state that the capital allowance should be charged in full. So where the examiner stated that, please, the annual allowance will be charged in full. But where the examiner did not mention anything like that, it will be prorated based on the number of months in the basis period. Where the number of months is 3, you are going to charge 3 months. Where it is less than 3, you're going to charge what? So that. Then what? It is deducted from cost to determine what tax written down value. So I made mention of something earlier to determine tax written down value, where I said what tax written down value is what cost minus what initial allowance. So when you now have annual allowance now, tax written down value will now be what? Your tax written down value will now be cost minus initial allowance minus annual allowance. So we give you what? Tax written down value. So we give you what? The annual the tax written down value, which is what? Which is utilized to determine what? Then we also have what? So any unabsorbed capital allowance, annual allowance in the year can be carried forward in the same thing with what? With your initial allowance. Any amount you cannot absorb in any particular year of assessment, you have a right to what? To carry it to what? To subsequent year. To what? To subsequent year for what? For until infinity. So how do we now determine what? This annual allowance. So how do we calculate what? Annual allowance. So I'm going to work that. So how computation of annual allowance. So how do we calculate our annual allowance? Computation of annual allowance. Our annual allowance depend on what? Computation depend on what? On the year of assessment. In the first year of assessment, your annual allowance is calculated at cost minus initial allowance divided by N. Cost minus initial allowance divided by N. So we have what is called N, big N. I multiply by small n, multiply by small n divided by 12. So multiply by small n, multiply by small n divided by 12. So we give us what? The computation for what? So the computation for what? For annual allowance. So annual allowance is what? Cost minus initial. So that means before you can even calculate your annual allowance, you must have calculated the first category of allowance, which I said is available to an asset, which is what? Initial allowance. So cost minus initial allowance divided by N, multiplied by small n over. So where our N? Where big N is what? Number of months. Number of months. Number of years to claim capital allowance. Number of years to claim capital allowance. And our small n is equal to number of months in the basis period. So I want to change this n. Instead of putting this n now, I want to change this information to m, because I'm still going to use that n somewhere else. So that's what was used in the material, so that it's not going to confuse us. So let me use m. It's just a letter, so I want to use m. So m is what? Number of months in the basis period. Number of months in the basis period. So to now calculate our annual allowance, please, in the first year, where your number of months in the basis period is not up to 12 months. Don't forget, we have stated that it has to be prorated. Your annual allowance will be what? Cost minus initial over n. This n is what? Number of years to claim capital. How do we determine that? If, for instance, if your annual allowance rate, assuming you are going to be told that annual allowance rate for a particular asset is, let's say, 20%. And we are expected to claim 100% of this one, of annual allowance. If I'm going to be claiming it 20% on a yearly basis, that means how many years will it take me to claim 100%? That will simply be 100 divided by 20. So that will give me what, 5 years. So that is how to determine the number of years to claim capital allowance. So you look at the rate, divide the rate by 100. So to get what, 100 divided by the rate, because you have to claim 100 is what, the entire rate for the entire useful life. So and you are going to be claiming it based on what? The percentage of what? Of the annual allowance. I just use 20% here. You can have a different rate for what? For different category of assets. So that's how to determine the number of years. So which is fine. The number of months, if the number of months in basis period is not up to what? Up to 12 months, please. So you also need to what? You also need to get what? To also make use of that. So number of months in what? In the basis period will be this M divided by what? Divided by 12. So that is what? In the first year. After the first year, you are expected to claim it what? Throughout the useful life of the asset. After the first year, you also claim it what? In the second year. So for subsequent year now, for subsequent years. So for subsequent year, there are two formula to calculate what? Annual allowance. The two formula, please, will not give us the same answer. The two formula is not going to give you the same answer in most cases. So, but what? The two formula is what? Is applicable. So depending on what you want to adopt. But I will advise you on which of the formula to be what? To usually use in order to what? Because one of the formula, so by the time you get to the final and you need to what? To make some adjustment. First formula in subsequent year. First formula is calculated as tax written down value divided by tax written down value divided by big N minus small n. We give us what? That is the first formula. Tax written down value divided by big N minus small n is the first formula. So why the second formula? Second formula is equal to cost minus initial allowance divided by cost minus initial allowance divided by N divided by big N. So we already know what big N is before. So what we need to know now is what? Number small n. Small n is now a number of years. Number of years in which capital allowance, number of years in which capital allowance has been claimed. Before the subsequent year, I did not say second year. I said subsequent years. That subsequent year can be what? The second, the third, the fourth, or any year. So before this particular year that we have now, that means assuming let's say we are in the third year now. Let's say we are in the third year. So before this third year, that means our small asset capital allowance will have been claimed in the first and in the second year. Capital allowance will have been claimed for what? For 2 years before we get to this third year. So in that scenario, in the third year, our small n will be what? Will be 2. So we know our big N already. Big N is what? Number of years to claim our capital allowance. And we also know what? The tax written down value. The tax written down value, as I told us, is what? Cost minus what? Initial allowance minus what? Annual allowance. So let us what? So please, in the exam, always adopt the first formula for your what? For your examination purpose. Because you can also make use of the second formula, but in making use of the second formula, adjustments need to be made at the end of the useful life for what? For the difference. But when you are using the first formula, you don't need any adjustment. That will give you what? A round and what? An accurate figure. So always what? Always adopt what? The first what? The first, always adopt what? The first formula. So Ibrahim, Abi, Samiat, you have a question?
Yes, sir, please. I want to confirm something. Please hold on.
Okay. Okay. I'm listening.
Okay, that that you said represents the number of
Number of
months
months.
the basis.
Yes.
So what I want to
Yeah.
confirm is that someone asked earlier that what if the asset was acquired few months before the end of the year. So are we going to use like the total number of the months in that basic period, or the number of the months the asset has used in that basic period?
Yeah. Good question. Number for capital allowance computation, you are going to use what? Number of months in the basis period. Number of months in basis period, not the number of months when asset was acquired. Is it clear? You use your number of months in basis period, not number
Okay.
of months when asset was acquired. So that is what you are going to use for what? For capital allowance computation. So that number of months for when asset was acquired is only for you to what? To allocate the asset to what? To the respective year of assessment. I hope it's noted. So then this annual allowance, it is expected that, we said you are going to claim it throughout the useful life of the asset. There will be a time that asset, you are going to get to the end of the useful life. If you want to claim it for 5 years now, you will definitely get to 5 years. By the time you get to 5 years, it is expected that asset should not be given a zero amount. By law, you are expected to retain 10 naira for what? For each category of asset. Please, at the end of the useful life of the asset, when you are computing, you are going to leave what? 10 naira as what? As the nominal value. As the what? Nominal value of that what? Of that qualifying capital expenditure. So that 10 naira is just to show that what? That is the value of the asset. The asset is having a value. So that value will be what? Will be compared, because that asset, by the time they want to dispose, they want to get rid of it. It's either what they dispose it as well at a certain amount. So that amount that you are going to dispose it is going to be compared with what? With this nominal value, to know whether there is going to be what? A gain or what? Or a loss. So for when you are computing your annual allowance, at the end of the useful life, you are going to retain what? You are going to retain what? 10 naira as what? As the nominal value of the asset. So let us take note of that. So 10 naira should be retained as the nominal value of what? Of the asset at the end of what? End of the useful life. So these are the what? These are those formula that I just explained earlier. Please. So for the subsequent year, always adopt the one with your tax written down value and what? Big N minus what? Minus small n. So that is the second category of what? Capital allowance claimable by what? By a taxpayer. Then the third category of capital allowance is what? Investment allowance. So investment allowance. Please, this asset is available on a particular category. This allowance is available on a particular category of asset. It's only available on what? Plant, machinery, and equipment. Take note of it. This investment allowance is available on what? Plant, machinery, and equipment. Is available on what? Plant, machinery, and equipment. So any asset apart from those categories is not going to qualify for what? Investment allowance. And this investment allowance is granted at the rate of what? Standardized rate of 10%. It's granted at the rate of 10%. It has a uniform rate, 10%. Then it is granted once in the lifespan of the asset. Like the same thing with what? With initial allowance. As you are charging your initial allowance, if you have a plan, if the taxpayer also acquire plant, machinery, and equipment, you're also going to what? Grant him what? Investment allowance at the once in the lifespan and at the beginning of what? Of the useful life. Then it is granted in full, irrespective of the number of months. So you are going to take it in full, irrespective of what? How many months you have what? You have in the what? In the basis period. It is granted in the first year in which the asset is put in the first year. It's not taken into consideration in determining your tax written down value. Please, investment allowance, you are not going to use investment allowance to determine your tax written down value. Investment allowance is not utilized to determine tax written down value. You are not going to use it in determining your tax written down value. Take note of that. It is not, so you only need it to what? To get your what? Your total capital allowance. It's only needed to get total capital allowance. It's not needed to what? To get tax written down value. So that means tax written down value is strictly what? Cost minus initial allowance minus annual allowance, excluding what? Investment allowance. Take note of that. So where any of the following any of the following conditions occur, so the investment allowance between for a period of 5 years from the date of acquisition, the investment allowance may be what? May be withdrawn by the what? By the tax authority. So what are those conditions? Where there is any sales or transfer of the asset, so where you sell the asset within 5 years of what? Of acquiring of benefiting what? The investment allowance. That investment allowance will be what? Will be withdrawn by what? By the relevant tax authority. Then also any appropriation of asset for a purpose other than chargeable purpose, where you are now using that asset for what? For personal usage. You are using it for any purpose more than what? For the purpose of the business. So where there is any sales or transfer or dwelling of that case where it appears, the purpose of obtaining tax, the purpose of obtaining tax allowance was the sole, so that is any sale or transfer or other dealing with asset being a case where it appeared that the reason why you obtain that investment is for what? For personal purpose and not for the purpose of the business. It's also what? The investment allowance will be what? Will be withdrawn by what? By the relevant tax authority. But you have to be very vigilant and careful. Please, this investment allowance has been abolished by what? By the Finance Act 2023, which take effect on what? On 1st September 2023. It was initially 1st July 2020, but it was extended by what? By the president, Bola Ahmed Tinubu to September 1st, 2023. So this investment allowance has now been abolished by what? By what? By the Finance Act. What that means is that what? Once you have any year of assessment, that is 2023 and beyond, you are not going to what? If the taxpayer acquire what? Plants, machinery, and equipment, that asset is not going to qualify for what? Investment allowance. But because what? That investment allowance is no longer what? Is no longer available again. But what? That law start from where? 2023 Finance Act, which is applicable from where? 1st of September 2023. So any year of assessment ranging from 2023 will not qualify for what? For capital allowance claim. So let us take note of that. So what that means is that what? Is that if you are given a question, so you need to be vigilant with what? With the year of assessment for you to know whether you are going to grant what? The investment allowance on what? On plant machinery or not, depending on what? On the year or when the asset was acquired, whether it fall within what? Year before what? It was abolished, or it fall what? Between what? Year after it was abolished. Then also this investment allowance, look at that word I said, it is available on what? Plant, machinery, and equipment. What that equipment, another name for equipment is what? Plant. It is not what? The same thing as office equipment, like your computer and so on. So no. Where they put office equipment, please, office equipment does not attract what? Does not attract investment allowance. The only one that attracts is what? Where it is stated as what? Plant and equipment, or they only write what? Equipment. Office equipment is just what? Your computer, your printer, so you are not using it for production. So the one that what we attract is what? Those that are utilized for what? For the purpose of production. So do we get that? So that is for what? For investment allowance. So you also need to be vigilant with the year. So to calculate this investment is very simple. It's just what? Your investment allowance is what? Cost multiplied by what? By 10%. So how much is the cost of that plant? Is the cost of acquiring that plant and machinery? You multiply by what? By 10%. So because the rate is what is a standardized rate. So it is the fact that you are using an asset for the purpose of your business. That does not mean that you cannot dispose the asset. When the asset is being disposed, that will give rise to what is called balancing charge and balancing allowance. Balancing charge. So we have one that is what? An income. We have one that is what? An expenditure. So we have what? Balancing charge and balancing allowance. So let me illustrate it here for better understanding. So we have what? Balancing charge and balancing allowance. So balancing charge, and balancing allowance. I told you that at the end of the useful life, you are set to retain how much? You can remind us again. How much as your annual allowance?
10
At the end
naira.
of the 10 naira, yes. That 10 naira you retain now. By the time you now want to sell that asset, you are going to compare that value, that 10 naira with what? You are going to compare that amount with what? With the sales proceed, that asset was disposed with. So you have what? The first one, we have a balancing chart, balancing allowance. So balancing allowance, this arises when your what? When your tax written down value is more than your, when your tax written down value is more than your sales proceed. You have what? Balancing allowance. That your tax written, let's say you have a tax written down value of the value of the asset is 100 naira. By the time you now want to sell that asset, sales proceed, you now sold that asset for 60 naira. So when you look at this, you can see that you have not yet what benefited all your what allowances. So the difference between the 100 naira minus 60 naira, that 40 naira is what is called what? Balancing allowance. So when your what tax written down value is more than your sales proceed. And this balancing allowance is what? Is an additional allowance that will be what? That is claimable by what? By the taxpayer. It is an additional allowance that will be added to your what? To your total capital allowance. So what that means is that what? Our total capital allowance will give us what? Addition of initial allowance plus annual allowance plus investment allowance plus balancing allowance. So the addition of these four will give you what? The total capital allowance. So it's a balancing allowance is what? Is an additional capital allowance. So, and it will only arise when there is what? Disposal of what? The qualifying capital expenditure. So let us take note of that. So we also have the second one, which is what? Balancing charge. Balancing charge, this arises when the sales proceed exceed is more than the tax written down value. So when the sales proceed is more than the tax written down value, you have a balancing charge. So this balancing charge is what? Is an additional income. Additional income that subject to tax. Balancing charge is an additional income that is subject to tax in the hand of what? In the hand of the tax payer. So when you have a balancing charge, let's say we also have sales proceed. Let's say we have sales proceed of, let's say 100, and we have tax written down value of 70. Our balancing charge will now be equals to 100 minus 70. So which will give us what? 30. So this 30 is an additional income. This 30 is an additional income that you are going to add as part of your what? Adjusted or accessible profit. So after getting accessible profit, you add it as what? An additional income, balancing charge. But there is a rule guiding this balancing charge. The rule is that for the maximum balancing charge to be claimable, must not be more than what? The total capital allowance claimed on the asset. The maximum balancing charge claiming must not be more than the total capital allowance claim on the asset. So this is the rule. So you can see this is balancing chart. This is what sales proceeds greater than tax written down value. Then it should be noted that the balancing chart to be subject to tax cannot be higher than or greater than the total capital allowance granted on the asset from the date of acquisition up to the point of disposal. Where the amount of the balancing charge is greater than the total capital and claimable on the such balancing charge shall be restricted to the amount of claimable, and the difference will be liable to capital gain tax. There's also another tax we call capital CGT, which is available on when there is disposal of chargeable assets. So what it means is that the balancing charge you are going to consider as an additional income must not be more than the total capital allowance you have claimed. Why? Because the total capital allowance you have claimed shows that is the amount you have used for what? For the purpose of business. Where there is any portion that you are not using for the purpose of business, and we have stated earlier that any portion, when you are claiming your capital allowance, the asset must be used for the purpose of business. So when you are charging any income you made from that asset also, it must also be what? Relate to what? The one you use for the purpose of the business. So it must not be more than what the total capital allowance claimable that has been granted on that asset. Where the value is more than it, any excess amount will be what? Regarded as what? Chargeable gain, which will be liable to what? Capital gain tax at the rate of what? At the rate of 10%, which is called what? Balancing charge. So this rule is only applicable to what? Balancing charge. Nothing like that for balancing allowance. So let us take note of that. Then we also have what is called another allowance is what? Export processing zone allowance. Those that are what? And purely engaged in what? In export. So when you acquire what? When you incur qualifying expenditure on what? Building and plants. So and you are in a manufacturing nature for the purpose of export. You are what? You are doing your business for purely where was 75% of your production are purely for export. Because government, they want to encourage exportation, and when there is exportation, there is going to be what? Inflow of what? Foreign exchange and foreign research. As a result of that, so you are going to be granted what? An allowance called what? Export processing zone allowance, which are the rate of what? 100% of the what? Of the cost of what? The asset. 100% capital allowance in any year of assessment. So the company shall not be entitled to what? Investment allowance. You know it's on what? Building and plant expenditure. And plant equipment is what is available to what? Investment allowance. So when your business is for the purpose of export, you have been given export processing zone allowance, you are not going to be entitled to what? Any investment allowance again. So those are the category of capital allowance that are available, that are claimable by what? By taxpayer. So and in the examiner will not ask each of them one after the other. You are expected to know what are the category, what are the capital allowance that are available to taxpayer. So based on what? Based on the available information. So those are the available capital allowance. So any question? Any
Yes, at least
question?
I want to confirm that. So balancing charge and balancing allowance are like opposite of each other. Like when sales is greater than tax written down
Tax written
value,
down
and
value.
when
Yeah,
sales is less
yes.
than. Okay.
Yes, they are the opposite of each other. Yes. Any other question? So in the absence, so we have what? Types of qualifying capital expenditure and their rate of capital allowance. Please, for this particular aspect, you don't need to what? To bother yourself or stress yourself. The examiner is going to give you these rates for the category of capital allowance, for the category of qualifying capital expenditure that are liable to what? Capital allowance claim. So you don't need to stress yourself. Just go to the back of your question paper. Once you lay your hand on any question paper, go to the back of that question paper. You are going to see the rate of taxes there. Part of the rate that will be given to you are the rate of capital allowance. You are going to be given the rate of capital allowance. So those rates will be given to you. And the rate that will be given to you is the one relating to company, most especially. So this rate is, because the one that relates to company is differ from the one that relates to individual. But we are going to focus our attention on the one that relates to company, because that's what will be provided by the examiner. So the rates for companies are what? are the following. So just look at the category of asset to know what is the initial allowance rate and the what annual allowance. Building expenditure 1510, industrial building expenditure 1510, manufacturing industrial plant 5025, mining 95 dash, plant expenditure, construction plant, furniture and fitting, motor vehicle, public transportation, motor plant equipment, agricultural plant, house, estate, ranching and plant, research and development. So those are the qualifying capital expenditure that will what attract what that will be available for what for capital allowance. Any expenditure you incur will be grouped under what any of these following category of assets. So those are as I said, don't stress yourself. So this rate and the percentage will be provided to you by what by the examiner. So as part of what as part of your question paper. So now to what treatment of asset acquired on what second-hand basis. Somebody asked a question earlier that so what will happen to assets that were acquired on what second-hand basis? So now to what? So now to your question now. So when your asset is acquired on question-hand basis, the requirement of the law is that those assets are grouped into two major forms. We have either you are acquiring building or other assets. Please, in the case of building, where you have land and building, is going to qualify for capital allowance claim. But where the examiner separates it, where you have land separate, you also have building separate. Please, land is not available for capital allowance claim. Who can tell me why do you think we are not going to claim capital allowance on land?
There is no
What do you
estimated
think is the
useful
reason?
life for it. Land
There's
does not
no,
have an
yeah,
estimated
land does not
useful life.
depreciate. Land appreciates in it. It's not like other form of category of asset that depreciate. Land does not depreciate. Land appreciates. So please, where the examiner separate them, they put land separately, building separate. It's only the building that is going to be available for what? The examiner group them together. Where the examiner puts land and building together, please, it will be available for what? Capital allowance claim. So take note. So for the purpose of the law now group what? Any asset that were acquired on second-hand basis, the law group the asset into two major forms. It is either you are acquiring building or you are acquiring other category of asset. Please, where building is acquired on second-hand basis, the following rule will be adopted. What are the rule? The rule is that what? No initial allowance will be claimable on that building. Where you are acquiring, so where you are told in the question that the building that the organization is using is acquired on what second-hand basis. Please, that building will not be available for what initial allowance. You are going to claim only annual allowance. Only annual allowance will be claimable on the lower of the original cost and the new purchase price. You are going to compare the original cost and the new purchase price. Any amount that is lower between the two is what you are going to base the annual allowance on. Please take note of that rule. The annual allowance will be based on what? On the lowest of the of the original cost and the new purchase price. So when building is acquired on second-hand basis. Apart from building, any other category of asset that fall as what QCE are regarded as what? Are regarded as other asset for the purpose when it is acquired on second-hand basis. And for other assets, where you are told that those assets are acquired on what? On second-hand basis, the asset will be available for what? For both what? Initial allowance and annual allowance and what? And investment and other category of allowance. Other assets where they are acquired on second-hand basis, it will be available for what? For all form of capital allowance, except where you are told that what? The transaction is not at arm's length. Where you are told that the transaction is not at arm's length. That is, the transaction is between related party. That is between what? Is between connected person. Where the transaction is between a parent company is selling to what? To a subsidiary. So because it is of the belief that the parents will have enjoyed what? That's what? That initial allowance. So where you are told that the transaction is between what? Related party is not at arm's length. In that scenario, it is only what? Annual allowance that's what? That will be available for that category of asset. But where that is not mentioned, you are going to claim both what? Initial allowance and annual allowance. That is number. Then, or if you are also told that what? That the asset is acquired from where? From another business entity. If you are told that what? This particular asset is acquired from a business entity. So because if you are acquiring from a business entity, it is of the belief that what? That business entity will have what? Will have claimed what? The initial allowance. And it is only what? Annual. So it is expected that the initial allowance is expected to be claimable only once. So in that case, you are going to claim what? Only what? Annual allowance. So, but where you are not told of any of these two conditions, you are going to what? The asset will be available for both what? Initial and what? Annual allowance claim. Then where assets are purchased on second-hand basis, no initial allowance can be claimed if it was previously utilized for business purpose. So this is what I just explained. Annual allowance to be claimed must be based on what? Only on the expired tax life of the asset. So where they tell you that it's acquired from a business entity, you are going to claim what? Only what? Only annual allowance on what? On the remaining useful life of the asset. So this one now has now what? Answered the question that that person asked me earlier. Previously, that's what. So what happened to asset that are acquired on a second-hand basis? So any question? Any question? Then the next one we have is what? Computation of capital allowance for small company. There are certain companies that are regarded as a small company. So they are regarded as what? Small companies. So what are those small companies? They are companies with what? For now, they are companies with annual turnover of what? 25 million naira and below. Where your turnover is what? 25 million naira and below, it is expected that your tax rate is what? 0%. The rule is that for a company with an annual turnover of 25 million and below, they are exempted from payment of tax. So where a company is having a turnover of 25 million and below, so they are also what? Exempted from payment of tax. So what the law is saying is that where you are exempted from payment of tax, you don't expect that government is now going to give you back your what? Your capital allowance. So what that means is that where you are a small company, the capital allowance is not what? Is not available for you. You are not going to claim what? Any capital allowance as a small company. So because you are not going to pay tax, there is no place for you to relieve that amount. So you don't expect that government should now give you the money. So capital allowance is not going to be available for claim. And government, they don't expect you to what? To be a small company throughout your entire life. They expect you to move from the small company to either medium or large, to move beyond that 25 million to either medium or large. So when you now move from small to medium, you are going to start claiming your capital allowance on what? On the expired useful life of that asset. The capital allowance will be claimable on the what? Expired useful life of that asset, which is what? Which is for small company. So but basically, for small company, during the period that they are small, they are not going to work. They are not entitled to a capital allowance claim. They will only start claiming capital allowance once they move to either medium or large company. So it is possible that that asset that they acquired during the time they were small. By the time they become big, that asset is still what? It's still the one they are going to be using for what? For business. And as at the time they are medium or big, they are going to be liable to tax. What the requirement of the law is that they are going to look at from the beginning, from the period that they were small, how many years have they utilized that asset for, to determine what the expired useful life of the asset, to know whether the asset will be available for capital allowance claim or not. Then also, there is also what? Restriction for capital allowance. So it is not all amount that you calculate. I told you earlier that the total capital, to get total capital allowance, you are going to add your what? Initial allowance plus annual allowance plus investment allowance plus what? Balancing allowance. When you add up all this, it will give you what? Total capital allowance that you are going to remove from your what? Accessible profit before what? That profit will be charged to tax. So this capital allowance you want to remove now, it is not this total, it is not the entire capital allowance that is what? That is expected to be what? To be removed. So capital allowance is restricted to what? 66 2/3 of accessible profit. Capital allowance is restricted to what? 66 2/3 of accessible profit. So what that means is that what, where you have, so let me illustrate that. It's restricted to 66 2/3 of accessible profit. So where you have, let's say you have a capital allowance claimable. You have capital allowance claimable of 200,000 naira. By the time you now have your accessible profit now happen to be 220,000. So what the law says is that by the time you want to remove this capital allowance, it is expected that we should remove the whole 200,000 from this 220. So by the time you want to remove your capital allowance, you are going to restrict it to what? 2/3, simply 2/3. Just calculate that's 66 2/3. So remove this 66. So just get what? 2/3 of what? This 220,000. If you calculate 2/3 of 220,000,
Yes, sir. We can see your working notes, sir.
okay. So what I mean is capital allowance claimable of 200,000. So you now have accessible profit of 220,000. So by the time this accessible profit of 220,000 that we have, you are supposed to what? To remove this capital allowance. You are supposed to remove this capital allowance of 200,000. But the law says that you cannot remove the entire 200,000 from this 220 because the government must still have something that they are going to work because they are going to collect as tax from you because they need those money to carry out what? Economic activity. This amount that you are now going to claim, amount to now be claimed, capital allowance claim will now be restricted to what? 2/3. It will be restricted to 2/3 of what? Of the accessible of 220,000. If you calculate 2/3 of this 220,000, you see that it's going to give you a value. It's going to give you 146,667. 146,667. So instead of you removing 200,000, you are going to remove this value of 146. We're going to remove this 146,667. So that's what they mean by what? Restriction of capital allowance is restricted to 66 2/3. So this balance, the difference between this minus this, the difference between this will be what? 53,333 will be taken to what? To next year as what? As capital allowance brought forward. Why this difference? The difference between this one, this minus this, will now be what? Will now be subject to tax, which is 73,000. On a normal day, assuming we did not restrict this amount, you know that the amount that will be subject to, if we are able to remove the entire 200,000, we only be what? We only be 20,000 naira. So because government, they need what? That tax. So that's why what? This restriction is what? Is introduced. So capital allowance is restricted to what? 66 2/3 of what? Accessible profit. But there may not be restriction unless where the company is what? Is a manufacturing company. Where that business is into the business of what? Manufacturing. So where the business is a manufacturing entity, no restriction of capital allowance. Please, let us be mindful of what? Of the nature of business of what? Of the taxpayer giving to you. So for you to know whether you are going to restrict or not. Where it is a manufacturing entity, no restriction, or Where what? Where it is what? The company is what? Engaged in what? Agro-allied business. Agro-allied is what? Those that are engaged in what? Agricultural business. So those two categories of businesses, capital allowance are not what? Are not restricted for them. So manufacturing company and what? Agro-allied, which is what? Agricultural business. So there may also be what? Element of restriction of capital allowance, where there is what? An element of private usage, where you are using any of that asset for private usage. So not all the amount will be claimable. It will be restricted to only the one for official use. So there may also be restriction where the basis period is less than 12 months. So in that case, for annual allowance, you base it on what? On the number of months in the basis period. So those are the period where capital allowance can be restricted. But where you don't have this, so please, no restriction of capital allowance for what? For manufacturing company and agro-allied business. So let us take note of that. Then we also have the Finance Act 2021 brought what is called what? Restriction of assets. So an asset, what do we mean by this? As far as income is concerned, we have two categories of income. We have those that are taxable and those that are non-taxable. We have taxable income and non-taxable income. So taxable income, there are those income that are liable to tax. So they call them what? Taxable income. So why non-taxable income are those income that are what? That are not liable to tax. So taxable and no. So what the rule is saying is that what? Where an asset is utilized to what? To generate both taxable and non-taxable income. Please, the portion that relates to non-taxable income will not be available for capital allowance claim. Only the portion that relates to taxable income will be available for capital allowance claim. In essence, what the law is saying is that so where you are making an income that you are not going to pay tax on, you are also not expected to be giving what? To be giving relief on that income. So any income that is non-taxable will also not qualify for what? For capital allowance claim. So only except where that income, where the proportion of that income to the entire income does not exceed 20%. Where the proportion of that income to the total income does not exceed 20%. So that income will be, so both the taxable and the non-taxable will be available for capital allowance claim. But where it does not exceed where it exceeds 20% of the total taxable income, only the portion that is taxable will qualify for capital allowance claim. Then we have the treatment of capital allowance on cessation. When it comes, we talk about cessation of business. When a company ceases operation, so it is expected that what will happen to their capital? Because when you are ceasing operation, you may still have unclaimed capital allowance. So what will happen to those unclaimed capital allowance that you have as at the date of cessation? So it is expected that those unclaimed capital allowance should be carried backward and relieved from your accessible profit from before the year of cessation for a maximum of period of 5 years backward. So for the purpose of charging the capital allowance, and any amount that you have after the 5th year will become lapse. So what that means that when a company is ceasing operation, any unclaimed capital allowance as at the date of cessation is not a waste to them. They have a right to carry it backward for a maximum period of 5 years and remove it from their taxable profit. So for a maximum period of 5 years backward. So any amount not utilized after the 5 years will become lapse. The question we may ask is that it is possible that those 5 years we want to consider back, they will have paid tax. So where tax has been paid for those periods, a refund of the tax liability will be refunded back to the taxpayer in form of tax refund. So those are the rules that we need to know as far as capital allowance is concerned, the basic one before we go to the higher purchase and computation. So what you are left in now is computation of the capital allowance. So how do we compute the capital allowance itself? Any question? Any question?